I see this as a bear market rally. I see one more decline to newer lows and this is nothing to do with gold. This is to do with, I see a financial deleveraging of all bubbles and debt and financial assets except for high quality bonds.
Ladies and gentlemen, welcome to the special interview. Today we have a first-time guest to the show, Harvard-trained economist Harry Dent. Harry is a prolific economist and author of several books. I suggest everybody head over to harrydent.com, sign up for his free newsletter, because I got to tell you, we're talking to the world's foremost cycles expert, and I'm not just talking about market cycles. I'm talking about war cycles, sunspot cycles, geopolitical cycles. Additionally, Harry is a leading expert in demographics, and that's going to matter big time with problems with Social Security coming down the pike, and it also has implications for the housing market. Harry, I'd like to thank you for joining us today on Silver Doctors.
Yeah, nice to be here.
Now, Harry, first question right off the bat. I'm looking right now and I see a gold closing price of $11.86 on September 28th, 2018, and I see a $15.60 closing price September 4th, 2019. Is gold in a new bull market?
No, I see it. Now, we did actually call this because I said gold was going to drop, especially when it broke 1525 in 2013. That's when gold did not see the inflation it expected from money printing, which is a conundrum. And then when it hit 1,050, I said, boy, this is way oversold. We're due for a strong counter rally. I saw that rally going about 1,428. Well, it just broke the magic number for me, 1525. That's where we had that breakdown in early 2013. And so once it's broken this, even on some pullbacks here, I would see the next target for gold likely to be around 1,800. That was the series of highs after the peak. So a lot of secondary peaks there, sideways channel for about a year and a half. That was the really important place. So I see this as a bear market rally. I see one more decline to newer lows and this is nothing to do with gold. This is to do with, I see a financial deleveraging of all bubbles and debt and financial assets except for high quality bonds. And like in 2008, when the stuff got bad, gold did go down. It was up ahead of that. So I think this is similar. I think it's up into the crisis. When the crisis hits in the next year or two, I think gold and other commodities will go down more, and then it'll be a buy of a lifetime. I mean, I see the next 30-year commodity cycle boom being even stronger because it's be driven by emerging countries, much more commodity intensive, consuming and producing. And China and India love gold, and they're going to dominate the future, not Western countries like the U.S. So I'm very bullish long term, but I don't think that this correction in commodities nor in gold. But I tell you one thing, gold has held up the best of all commodities and metals, showing it does have that extra kind of secret quality.
Now, I'd like to get to the bond market, and that ties into an excellent question because we hear everything about quantitative easing. Just yesterday, I'm not sure if you're aware, but President Trump came out with a tweet calling the Fed boneheads, and he said we should get rates below zero. And he also said we should substantially lengthen the term. So I don't know if that's an ultra-long 100-year bond. I don't know if that's a 50-year bond. So here's my question when it comes to that. When we see all this money printing, when we see these extending of the durations, when we see interest rates driven negative, are you changing your downside target on gold? Are we still going to 450 as you had forecast? Are we still going to 700? Or are you having to now bring up any of those targets, Harry?
Oh, yeah. I already did, by the way. My original targets were worst case 450, best case 700. Now my worst case is 700, best case just a slight new low at 1,000. Because gold, I have a bubble model now for everything, commodities, real estate and stocks. They're all a little different, although they're primarily similar. And gold and Bitcoin were the two things that bucked the model on the downside. They did bubble, they did crash violently, but they did not go down nearly as much as most. Most bubbles almost totally destroy themselves. So that puts gold in a different position now. I have raised my targets for gold. I still think most commodities are going to end up down 80%, like oil and iron ore already have. Gold, I'm seeing down only more like 50% or a little more. That's a huge divergence from the rest of the commodity and metals pack. So I have raised those targets for gold. I still think we are going to at least see new lows in the real downturn. We saw the first downturn 2008-9. All this money printing, very simple, fighting deflation, blowing our way out of it, avoiding restructuring debt, and taking the hard hits you're supposed to do in a time like this, and like we did in the 30s in a similar scenario, in a similar phase of the economy. They're doing all the wrong things, and Trump is an idiot saying this. He came in saying this is a big, fat, ugly bubble. Now he's telling the Fed, keep this bubble going, get me reelected. He already looks bad. He's going to look horrible in history, exactly for what he just said just recently, on top of everything else. So this is utter stupidity. It's one thing for him and a politician to do this, for Fed chairmen around the world, central banks, to say, oh, the only solution to the problem is just print money without a ban and just take the easy way out and it'll all turn out okay. This is the stupidest thing I've ever seen in history. No accident that the last time the Federal Reserve was created in 1913, 20 years later, we were at the bottom of the greatest depression in history. They only make booms better. They don't let the economy weed out the inefficiencies and take the hits and the debt and stuff. So you just get a bigger bubble and you get a bigger deleveraging and depression at the end of it. That's what we're heading for the next few years. That's the only thing that's going to bring. Gold would not go down if it were not for this financial asset and debt deleveraging. Gold is an incredible inflation hedge. It's not really a deflation hedge. That's what it's got to get through. As soon as we get through deflation, next commodity bubble, inflation comes back long term, not as high, but the emerging world's going to drive, and that is going to be gold's oyster.
Now, you're bringing up so many wonderful points that just stimulate so many questions. A lot of people would say, as far as the deflation, gold is going to lose less purchasing power, less in real terms, so it's going to gain a purchasing power. However, also to make up a clarify point, you're essentially saying we're still in the bear market. So a bear market rally is that we're in an up movement for any of the new investors out there, and still what is a downtrend that you're
still
seeing.
In a downtrend, and we're going to come probably close to the highs. I do not see new highs. Now, if that happens, then I'm going to have to really relook at stuff. I do not expect new highs. Gold has peaked in the past with the commodity cycle every 30 years. It peaked in 1980, right, with other commodities. It just went higher, and then it had its own crash and stuff. But this commodity cycle has peaked. It should bottom around 2022-23 when we see a lot of other things bottoming, stocks and stuff. And then it's going to be a bull market in a lot of things. But I think commodities will outperform U.S. stocks in the next bull market.
Are we going to hit 1,800 this year, early next year? Because that's another question. You're talking about the great crash of 2020. I want to get to that. There's so much I want to ask you. But let's step back again one step further. What are your thoughts on silver? Because you write a lot about gold, you write a lot about housing, you write a lot about the automobile sector, you write a lot about the stock market. What are your thoughts on silver?
Well, silver is not quite as monetary metal leaning, although it has that too. It's more industrial, but gold has that too. Gold has jewelry and industrial uses. And consumers, buy it for more than just investment. Jewelry is a big deal, especially in India and China, especially India, actually. So silver it trades more like gold. It's just more volatile. It'll go down as much as 2 times as much. It'll go up as much as twice as fast, as we've seen recently in the bounce. And so I think silver in the end will have more downside than gold. Gold has better downside protection and things like you say against deflation. I would disagree with the deflation. I think deflation may be 15, 20%, but gold from 1,800 could go down 50%. So I think it will do better than other commodities and things, and way better than stocks and real estate in a deflationary environment. You're right. It will not go down as much, and the deflation will offset in real terms. It just won't offset it fully. But you're right. I would rather hold gold through this than stocks. Let me make that clear. Or other commodities like oil or iron ore. And silver is going to have more downside potential. I tell you what, when the bottom hits, say in 2022 or 23 in my scenario, I would buy silver early on over gold because it's going to bounce back stronger and going to get hit harder on the downside. I think silver could end up at $10 or something. So that's woo.
Okay. Now you're looking for this great crash to begin sometime. I don't know if you're saying the end of 2019, but certainly by spring of 2020. So my question to you is, what exactly is this great crash, and why are we going to have it?
Okay, this is built up. I mean, we put the economy in 4 seasons. Real quickly, the 42 to 68 boom, Bob Hope generation spending, that was a spring boom coming out of a winter crash and deleveraging. So mild inflation, good boom, stable boom, nothing like this one. And then an inflationary recession into the 70s. So high inflation is bad for bonds and stocks and for the economy. It's great for gold, the best for gold. It's great for commodities, great for emerging countries that produce commodities. So, and real estate holds up. Real estate is an inflation hedge like gold. So that's the 70s. The fall bubble boom season, 1983 to 2007. Baby boomer spending, interest rates coming down. That will lead to natural bubbles. Things are so good. But then we had, the Fed stimulating all along, and now we go into the winter season in 2008, and the central banks go off the charts. And for one of the rare times in history, although this has happened before, the final bubble, which does come from stimulus in the winter, has taken stock markets and mini markets to new highs, which means we got the worst of the crash ahead of us. The winter season is from 2008 to about 2023 in my model. So in the 30s, we saw the worst crash up front. Because of such massive stimulus, we're going to see the worst. We've kicked the can down the road, and it's going to hit hard by my forecast between 2020 and 23 for the economy. And I think stocks and things like gold will probably bottom before that in 2022 sometime. Gold could bottom even earlier. So that's the scenario and why it's different. So when does it start? This bubble's been building, especially since the last phase is 2009. We had the first tech bubble in 2000, big crash. Second one really starting in 2009, extending longer. It's going to take 2 to 3 years to work this out. The way the bubble's looking to me, and the hardest part is when it bursts, not what happens after it bursts. That's a piece of cake. It's going to burst very quickly at first, and it's going to take 2.5 years to go down 80% or more. That's easy. Scenario number one, that we're kind of hitting resistance here. We go down one more correction. The NASDAQ makes new highs, but the S&P and Dow don't mid next year, more like March to May. And that's the more bearish scenario. We don't go as high. The more bullish one is this bubble has taken a setback, but it just keeps going up. We got to break a little higher to prove this in the next few weeks. We just go. Next thing you know, NASDAQ's at 10,000. I'm going to say sell your stocks. And then look for the crash. And then you're looking to buy everything from Asian stocks, the best, and commodities and the best metals like gold and silver in the downturn when we see bottoms in different markets. That's what I'm looking at. I think it's going to happen. It could be happening now for the Dow and S&P, but I think the final top, particularly in the leading bubble, which is the NASDAQ and tech stocks, between January and May of next year is my best target. Scenario 2 is more March to May. Scenario 1's more January to March.
Now, just a follow up. You had been talking about a dark window. Is that a buying opportunity or a selling? What is your dark window you're seeing?
It's a buying opportunity. It's like 1998. Tech stocks went through a bigger correction than we just saw in late 2018, but similarly, right on this lag, and then had the final run into early 2020. Well, that's what we're looking at here. Late 2018. Into early 2020, bam, you get this final run. The question, does the NASDAQ go to 10,000 or does it go to more like 8.5 to 9? That's my two scenarios right now. That's the dark window. It's the final rally. So you don't get out here. You kind of hang with the markets until they start to look a little more tricky. But man, if it does hit that on this final run, you better sell early than late. I'll tell you why, because and I've documented this over the last century, big bubbles like this in stocks, the first crash averages 42% in the first 2.6 months, and that's exactly what the NASDAQ did exactly in the first crash in 2000 from March to May. So, boy, if you get out too late, you get really whacked in stocks.
I wanna ask you about the dollar and interest rates one more time in relation to the crash, and I'm gonna just jot that down right here. But you're bringing up an interesting question that I want to ask, because you are heavily into the cycles.
Yeah.
And just last week, Dudley, ex-Fed head from New York, comes
Right.
out and says it's the Fed's duty. I'm paraphrasing here, but it's the Fed's duty to crash the economy so Trump doesn't get reelected. Here's my question. How do these dynamics play into the cycles? Do these kind of external factors matter with the cycles, or are they just things that help me understand? Because this seems like a curveball into the cycle, or is it just something that fills in the cycle as it's playing? Help me understand that, Harry.
Yeah, that is an excellent question because that was my first thoughts. Our demographic, our most important side. I'm known for that. I only invented this in the late 80s. You can tell when generations are going to peak in spending. You can tell how long stocks are going to go up, when they're going to peak, decades in advance, not years or months or weeks. And we called the 2007 top 20 some years before it happened. Well, we did see a depression like crash in the first year. 2008 looked like 1930. But hey, unlike 30, central banks around the world coordinatedly printed a couple $1 trillion in the first year and have printed 16 trillion plus ever since. This is what's unprecedented. So I'm thinking, oh yeah, this is a curveball. This has never happened before. Oh yeah, stocks going to new highs in the winter season. We got a bubble rally 32 to 37 from stimulus and all this stuff, but not like this. But then I found years ago a final cycle, a 45-year technology cycle, which every other cycle, when technologies build on each other, you get a 90-year super bubble. 1837, 1929, and now 2019 and 20. Almost exactly now, well, the bottoms in 1842, 1942, and now I'm projecting 2022 exactly on 90-year cycles. So the truth is, this whole central bank stimulus, they're actually playing into this more tech-driven cycle. And now you see, internet peaking and cryptocurrencies emerging. That's the big bubble in tech stocks. And this 90-year cycle, they're playing right into this super bubble, which has made me switch this 45-year and 90-year technology cycle to my number one in my hierarchy and shift my demographics, which is still very important, to number two. This is proving to be the quote-unquote Trump, not a pun, cycle here. Trump is going to get killed by this 90-year cycle. He doesn't need the Fed to do it for him.
Okay.
Even if he gets reelected, he's going to get killed by it. That'd be worse. He would be lucky to be forced out, or the polls be so bad he decides not to run. He blames it on the Fed for not stimulating enough, and then somebody else gets in and the economy crashes a little later maybe than I'm predicting, and then at least he doesn't get blamed 100%, just 80%.
Now, a lot of people are saying that interest rates can't go negative in the United States because of the world reserve currency status. Before this final peak in the stock market that you're talking about, do you see interest rates, for example, let's just say the 10-year note, do you see interest rates going negative in the United States? That's question number one. And then related to that, talk to me about the dollar as the stock market is peaking and as we're going through the crash. What happens to the dollar in all of this, and are interest rates going negative, Harry?
Well, I'll start with the dollar. My answer is same thing in 2008. When the recession started and it looked more benign, gold went up, anticipating some money printing, stocks went down. When things really fell apart in the second half of 2008, the dollar went up 27, 28%, gold 33 down, silver down 50%. That's when the real stuff showed up. That's when a brief surge of deflation. Well, how did they fix that? Very quickly. Flamethrowers, trillions of dollars of stimulus, you reflate the economy instantly. So obviously the easy way out. So that's what happened there. The dollar is the safe haven. I see the dollar, it's been at 98, it keeps crawling up. I think it'll probably correct sometime, but I see the dollar going to 120 or something in the crisis. Then I'm neutral on the dollar long term. I see gold going down, and then long term, I would be anti-dollar. Asia's taking over the world. We have seen our best days, and I'd be pro-gold because Indians and Chinese love buying gold, and the next commodity cycle starts. So interest rates. Interest rates are really simple. We've seen the biggest cycle in inflation ever was not caused by central banks, was caused by baby boomers entering the workforce at great expense. Inflation peaked in 1980. Bond yields peaked just afterwards because they were still suspicious. 81. We've had a 40-year bear market in bonds. Bond yields going up, bond values going down from 41 to 81. Now we're going to have a similar 41-year bull market with yields going down into 2022, bonds are the only things that don't crash. Commodities crash, stocks, real estate, high quality bonds, same thing in the 30s. They're the safe haven, especially in US dollars, because US, no, we're doing all the wrong things. We're nowhere near as bad as Japan, demographics or money printing. We're not as bad as Europe in money printing. They printed way more than us. Japan's made us all look like nothing. We're the best house in a bad neighborhood on debt, on demographics, and money printing. So the world comes to us as the safe haven and buys our treasury bonds and our AAA corporate bonds. That's the place to hide. Now, when that happens, people will think you can't go wrong buying bonds, like you couldn't go wrong buying real estate. That's when you flip back into global stocks, more Asian, and when you get into gold and commodities. Those are going to be the best. Asian stocks, metals, and energy and commodities are our two best picks for the next bull market from 2023 to 36, 37. That's already in the cards with demographics.
Now, so when we're coming through this crash, what are you making of statements, for example, when Mark Carney was out in Jackson Hole a couple weeks ago, and he's saying we need to move away from the dollar, possibly something crypto-esque such as the Libra. So what do you make about statements like that? So you don't see the rest of the world moving on from the dollar. You see the dollar regaining its strength in its place and maintaining that world reserve currency status is what I'm hearing, Harry.
Yeah. Yes and no. In the crisis, absolutely. Crypto doesn't have anywhere near the value. Gold would be a better short-term replacement for the dollar than crypto, because even Bitcoin, the entire crypto market is not valued enough to be anywhere near a standard. And it's not, it's the least stable. You think gold's volatile and everything else. That's the most volatile thing in the world right now is Bitcoin and cryptocurrency. They will not work in the downturn. That's the delusion of the blockchain and cryptocurrency. In the long term, it is a major thing. I think that could be a major solution as it grows. I think a basket of currency could do too. In the downturn, like in 2008, in an emergency, it will naturally go to the dollar. I do not see the dollar maintaining its reserve currency 10 to 20 years from now. Asia is only going to dominate. I've got all the demographic trade. It is crystal clear. I'll tell you what else is crystal clear. It ain't going to be China that's going to lead the world apart. It's going to be India. India booms longer demographically. India is stronger at its level of urbanization than China was. India is going to be larger and a bit richer and going to be dominated. But Asia is going to dominate the world for the next 80 to 100 years. And so there's no way you keep the dollar as the reserve currency more than another decade, maybe, or 2036 at the latest, the next boom. Dollar cannot be the reserve currency, but it will be during the crisis and for many years afterwards. You're not going to, there's nothing to replace the dollar, and it already worked just fine in 2008. It showed the strength, and so did the bonds. And so high quality bonds and the dollar are the safe haven. Gold a bit, but not fully, as it was not in 2008. So gold's the next best. Cryptos, I think, are going to crash like the internet stocks in this crisis. They're the last bubble of bubbles, and they're going to crash the most, down 95% or more. And then I would buy blockchain companies and Bitcoin long term. You could have a 15-year boom after that, like the internet had. Cryptos are not going to be the solution short term. It's not possible.
Now, Harry, a lot of gold and silver investors are looking to China to sort of rise up. We also hear people such as, for example, hedge fund, like money manager Kyle Bass, for example, talking about China's impending implosion, and a lot of experts and analysts out there talking about China's impending implosion. So what it sounds like I'm hearing is that, I don't think people are anticipating this rise of India that you're talking about. So
no, they are not. That's going to be as big a surprise as when I projected Japan would be the big crash of the 90s when everybody else boomed. People thought I was an idiot, nutcase, lunatic. China is going to be hit the hardest by this crash because they have overbuilt everything more than any emerging country in history, and they're still an emerging country. They're not at developed country levels except on the coast. And India, when they will be the slowest to come out of this in Asia. India will be the fastest. People will see, well, where do we invest now that China doesn't look so good? China will come back. Their demographics are horrible. Their urbanization is still there to grow, but they have so overbuilt. It may be 5 years after the bottom before China's back. India is going to be running by then. So India is going to be the surprise. China is not going to go away. They're still going to be number one economy for a long time once they surpass the US, maybe 10 years from now. But India is going to be ultimately the large economy, and it's going to grow faster all the way from here on out. China will, mark my words, never grow sustainably at 10 to 12% again, ever. In my lifetime or your lifetime, I don't care how old you are. Not going to happen. India could do that. But China's not out. China's just going to be mortally wounded. They are the epicenter of this great bubble. Like the last 90-year cycle, the U.S. we were the new up-and-coming emerging country becoming developed. New York was the new city like Shanghai, blah, 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 blah. We were the China. We were the epicenter. We took the biggest hit in the Great Depression and the strongest crashes.
Now, we've seen reports recently that India's silver imports tripled over a year ago, and I'm not sure if it was the last month or the last couple months. But coming at it from a gold and silver investor point of view, a lot of people think that the world has to go back to a gold or a gold and silver or a silver standard or something like that. And we already know that India is heavily into gold, and it appears they're now heavily into silver. Do you see the world going back to gold and silver as a gold and silver standard, or how do you see currencies in conjunction with the rise of India here?
No, I do not, for a couple of reasons. All the gold in the world can fit in an Olympic-sized swimming pool, I am told, and from a pretty accurate source. That gold we used to be in a commodity economy. Even the Western countries leading up till the early 1900s, gold was a perfect standard. It was concentrated value. It was a part. Gold does not represent the growth of the new technology, information, healthcare, whatever, financial economy like it did. There's not enough of it. It is too volatile to be a standard. Bitcoin would have to get huge and more stable to be maybe such a standard. That is a possibility, or a basket of currencies, something else. So I do not see it being that. I see the reason Indians like gold and silver is they are poor people, and when they get a little money, they like to show their wealth in little ways, and nothing better than gold and silver. And Indians wear gold in more places than anybody else can think of wearing. Indians are going to be the best thing that ever happened to gold when they start to lead the world in growth. They love gold, and they're not socking it away for the next depression or inflation surge. They like to show off with it.
Now, you are a demographics expert. I have to ask you a question about demographics, or we're just going to be left unfulfilled today, Harry. Talk to us about demographics. You've been tying demographics into the housing market, into the auto market. Recently, you've been talking about the RV sector, although you've been talking about how that's signaling an upcoming recession. But here's my question. We know Social Security is a mess. When's it going to go bankrupt? Is it going bankrupt? However you want to take this question, what does demographics mean, and how does it relate to what is coming to the United States?
Well, first of all, real quick, demographics have been driving the booms and busts. Baby boom predicted 46-year lag for peak spending on the birth index. Boom, 83 to 2007. We've been living on emergency ward PUE ever since to make up for the lack of demographic growth. But generation before that, Bob Hope, 42 to 68. Then we went into a 12, 13, 14-year recession with high inflation from massive baby boomers entering the workforce. So demographics are the biggest thing driving the booms and busts in our economy, and inflation of all things. For demographics on the negative side, yes, aging populations, baby boom aging. I can tell you today, when the most baby boomers will be in retirement, hitting Social Security, Medicare, Medicaid the hardest, 2029. They won't stop dying and retiring and stuff until 2042 or so. But it's going to be the worst there. This crisis is going to show us we can't even afford the Social Security and Medicare we have when the economy goes down and Treasury revenues plummet, and people see, well, growth's not going to be, people are going to see it. The only reason they think Social Security might kind of somehow a little bit work out if we grow at 5% forever without a recession. Well, that's not going to happen. So first thing is, oh my God, we can't even afford our entitlements. Just like, when labor unions finally wreck an industry with such high benefits and wages, and it goes down, then they say, okay, now we'll take lower benefits because they realize there's no way to get them. People are going to start realizing we're not getting all these benefits, and we're going to have to restructure them. Very simple how to do that. Retire at 75 instead of 65. That's how much our lifespans have gone up in the last couple of decades. We haven't adjusted for that. People are staying in on the dole half the time they worked and paid in the system. That's not sustainable under any system. So entitlements are going to have to get killed. The whole most inflationary industry in our country is higher education. Going to get killed. This mafia is going to get wiped out. College degrees don't pay in a boom. They're not going to pay in a bust at all. And people aren't going to pay those prices. So big resets in everything. Demographics tells me also, where do you invest? The Western countries, East Asia, Japan, Korea, Taiwan, Singapore, they're dead. No more growth. All the growth is in emerging countries. India, Southeast Asia, the most profitable, high productivity growth and pure demographics population. All the population growth is going to be in Africa. They're just still going to be the poorest part. Southeast Asia and South Asia, India are going to dominate the boom in the economy for decades to come. And the population growth and growth for them as markets is going to be Africa. So the whole world pushes to Asia, Middle East, Africa, Europe dead, North America barely alive, Japan and East Asia dead. That's a whole new economy. Nobody's seeing that. Demographics will tell you that crystal clear. I don't make guesses at long-term trends. I make guesses at short-term trends, like when this crazy bubble's going to peak. That's a guess out of one or two scenarios if I can get it down that narrow. Long-term, I predicted 20-some years before it happened that the U.S. economy would peak in momentum in 2007 when baby boomers predicted peak predictably in the highest numbers in their spending. Duh, easy calculation. 10-year-old could have done it.
Last question, Harry, just to leave our viewers with what you're looking at as we come into the end of the year the most. What is going to be the most on your radar? Because we've talked about a lot of different things as far as the stock market bubble, as far as the bond market, as far as the deflationary crash. What are the couple things that you're going to be looking at the most as we come into the end of 2019, and anything that you're going to be looking out for as we head into the election in 2020?
I'm looking at three things in the markets. I'm looking at this megaphone pattern. We've had three tops in a row, slightly higher highs with crashes, the lower lows in between. If that megaphone pattern holds near term, we can't break up 3 or 4% above recent highs. Stocks could go down even deeper and then have that final run. That's my scenario 2. So if we break above that megaphone pattern, I got scenario 1. So that's very important, especially in the next few weeks. I am looking at I am looking at gold prices, and I'm looking at bond yields, treasury yields. Treasury yields keep going down, then the Fed is going to be forced to get more aggressive and easing. They're going to have to say, they're not going to kiss Trump's you know what, because that would look bad. Bonds are saying the world's going into recession, not just the U.S., the world more so. If that keeps happening, they're going to almost have to press gold. So gold and bond yields are going together. Lower bond yields, higher gold. Lower bond yield, a recession coming. And that gold sees, that means they're going to have to print a lot more money and have a currency war. Gold wants that. So if gold prices keep going up and bond prices keep going down, that favors scenario 2 of my stocks, a less high peak and a later peak. If gold starts to reverse back down short term and bond yields keep going up like it's happening short term, which I don't think is the most likely, then stock prices just keep going up and we blow out earlier. So I'm looking at stock patterns. Gold and bond prices are the most important thing I'm looking at to determine which way that's going to go.
And to make it clear, you are looking at gold to continue rising into the end of 2019.
Yes, that's the most likely scenario. And that would see falling bond yields continued, and then stocks would correct. Stocks are not going to like that scenario. Stocks don't like gold. Gold and stocks are going opposite here. So that could put scenario 2, bigger stock crash, and then a final try to rally that will fail for most indices, and then it's over. So yes, that's the most likely scenario. But if the scenario 2 happens, gold would pull back for a while. Stocks would keep going up. Gold would probably go up into the late stages of that rally or in the early stages of the crash next year, as it did in 2008. Remember, 2008, stocks peaked October 2007. Gold didn't peak until June 2008, and then both of them crashed together in the last part of 2008. So that gold would vary, but yeah, I would bet more on gold going up the end of the year and stocks going down, but either way could happen. That's why I'm looking at all three of those. They affect each other. Gold up is bad for stocks. Gold down is good for stocks, short term.
Harry Dent, thank you for joining us today on Silver Doctors.
Okay. Obviously, the gold bugs are contrarians and always have been. Well, they're saying, well, God, this guy's contrarian to us. Oh, my God.
Yeah, that's good. That's good. And you are bullish long term, so that's the thing that people get lost on too.
I think you'll see gold 4,000 or 5,000. It'd just be if it's going to go to 4,000 or 5,000. Wouldn't you rather buy it at 700 than 1,500?
They're also listening to you, right? So it's like, it's almost like, it's like, you got to have a nemesis or enemy or whatever you want to, a rival.